Picture this. You're scrolling through social media and you see a guy in a Lamborghini talking about how he turned $5,000 into $200,000 in just 3 months, all from day trading stocks on his phone. Sounds amazing, right? So you think, why not me? You open a brokerage account, you start watching the charts, and 6 months later, your account is down to pennies. Sound familiar? You're not alone. Welcome back to Compounding with Callie, the channel where we break down real financial strategies for real people who want to build actual, lasting wealth. Today, we're getting into one of the most misunderstood topics in personal finance: the difference between day trading and long term investing, and why they are not even remotely the same. Here's what we're going to cover. First, what day trading actually is and why the odds are brutally stacked against you. Then, we're going to talk about long term investing, what it looks like, why it works, and why it has made ordinary people millionaires over time. And then, we're going to bust the myth that saving money in the bank account is enough, because it's not, and the math will show you exactly why. By the end of this video, you're going to walk away with a clear picture of what actually builds wealth, and it's probably not what social media is trying to tell you. Okay, so let's start with day trading. At its core, day trading means buying and selling financial assets, stocks, options, crypto, you name it, within the same day, sometimes within the same hour, sometimes within minutes. The whole idea is that you're trying to profit from small, short-term price movements. You're not interested in owning a piece of a company for years. You're trying to catch a wave, ride it for a few minutes, and jump off before it crashes. Now, on the surface, that sounds exciting, and it is, in the same way that a casino is exciting. You get that adrenaline rush, the screen is moving, the numbers are flashing red and green, and every once in a while, you hit a big win. But here's where the excitement ends and reality begins. Multiple studies, including a widely cited study out of Taiwan that tracked day traders for over 15 years, found that approximately 70% of day traders lose money. And it gets worse. The study found that less than 1% of day traders are consistently profitable year over year. Less than 1%. Think about that. If you walked into a room with 100 people who all decided to become day traders, statistically, maybe one of them was going to make it work long term. The other 99, they're going to lose money, lose time, or both. And here's why it's so hard. You're competing against professional hedge fund managers who have teams of analysts, supercomputers executing trades in milliseconds, and decades of institutional knowledge. You, on your couch with a laptop and a Robinhood account, are sitting across the poker table from the best players in the world. And that doesn't mean you can't win a hand, but the odds are not in your favor, and the house always wins over time. Now let's talk about something that doesn't get discussed enough: the actual cost of day trading, beyond just the losses of your trade. When you buy and sell assets constantly, you trigger what's called short-term capital gains tax. In the United States, any asset you sell within a year of buying it is taxed on ordinary income. Depending on your tax bracket, that could be 22%, 24%, or even 37% of your gains going straight to the IRS. Compare that to long-term capital gains, where assets held for over a year are taxed at a much lower rate, typically 0, 15, or maybe 20%. And it's not just taxes. Every trade has a cost. Even on platforms that advertise zero commissions, there are bid-ask spreads, market impact costs, and for option traders, fees that eat into your returns every single time. When you're trading dozens of times in a day, those costs compound against you. This is why so many people blow through their accounts without even realizing it. They win some on some trades, but after taxes and fees, they're actually losing. Let me give you a real-world example that really puts it into perspective. During the GameStop short squeeze in early 2021, millions of retail traders, regular people like you and me, piled into the stock as it shot from around $20 a share to nearly $500. Some people made life-changing money, but the vast majority of people who jumped in late, chasing the momentum, they bought near the top, watched it crash back down, and lost thousands of dollars in a matter of days. The people who won big were mostly early and out fast. The people who got hurt were the ones who saw the hype, felt the fear of missing out, and made an emotional decision. This is day trading in a nutshell. For every winner, there are many more losers. So if day trading is such a minefield, what's the alternative? This is where things actually get exciting, because long-term investing isn't sexy or flashy, but it is the single most proven method for building real, lasting wealth. And I mean that. Let's get into it. Long-term investing is exactly what it sounds like. You put your money into assets, typically stocks, index funds, or ETFs, and you hold them for years, or even decades. You're not trying to predict what the market is going to do next Tuesday. You're betting on the fact that over a long period of time, the economy grows, companies earn more money, and the value of your investments rises with it. And history backs this up in a big way. The S&P 500, which is an index of the 500 largest publicly traded companies in America, has returned an average of about 10% per year over the last century. Not every year, of course. Some years it drops. In 2008, during the financial crisis, it fell about 38%. In 2020, it dropped over 30% in a matter of weeks when COVID hit. But every single time it recovered. And then it went higher. Here's a real number that should make you sit up straight. If you invested just $10,000 in an S&P 500 index fund in January of 1994 and done absolutely nothing, no trading, no panic selling, just left it alone, by 2024, that $10,000 would have grown to roughly $200,000. You didn't have to pick the right stocks. You didn't even have to watch the charts. You literally just had to wait. This is the power of compounding. Albert Einstein, though debate exists whether he actually said this or not, is often credited with calling compound interest the eighth wonder of the world. And whether he said it or not, the math is undeniable. When your investment earns a return, that return gets added to your principal. Next year, you earn a return on that larger amount. The year after that, even larger. Over time, this snowball effect becomes enormous. This is literally what the name of the channel is about, because compounding is the foundation of every single wealth building strategy worth talking about. Now, I want to take a moment to address something that I hear all the time from people in their 30s and 40s. The idea that if you just save your money and keep it safe in the bank, you'll be fine for retirement. I understand the appeal. Saving feels responsible. It feels safe. And it is better than spending everything you make, for sure. But here's the problem, and this is the big one. A standard savings account is not keeping up with inflation. Here's what that means in practical terms. The average inflation rate in the United States over a long run is roughly 3% per year. That means every year, a dollar in your pocket buys about 3% less than it did the year before. Now, if your saving account is earning 1% interest, which is on the generous side for most traditional accounts, you're actually losing purchasing power every single year. Your balance might go up by 1%, but the cost of living is going up by 3%. You're falling behind while feeling like you're doing the right thing. Let's put some real numbers to this so it really lands. Say you have $50,000 over the next 20 years and you just leave it in a savings account earning 1%. At the end of the 20 years, you have about $61,000. Not bad, right? Now compare that to investing with the same money. Even in a modest portfolio returning 7% annually, after 20 years, that $50,000 becomes nearly $194,000. Same money, same 20 years. The only difference is where you put it. That gap, the difference between $61,000 and $194,000, that is the cost of playing it too safe. And for people in their 30s or 40s, I want to be clear. You still have time. The best time to start investing was yesterday. The second best time is today. Even if you're starting at 35 or 40, you could have 25 to 30 years of compounding ahead of you before traditional retirement age. And that is a lot of runway. Do not let anyone tell you that you missed the boat. So let's bring this all together, because I want to make sure that the contrast is crystal clear. Day trading is a high risk, high stress, and statistically, most people who try it will lose money. It requires a level of skill, discipline, and market knowledge that takes years to develop. And even then, the professionals with every advantage still get it wrong regularly. If you have extra money, and you generally don't mind losing it, and you want to treat it like a hobby, fine. But do not mistake it as a retirement strategy. Do not bet your financial future on it. Long-term investing, on the other hand, is the boring, reliable, historically proven path to wealth. You don't need to pick winning stocks. You don't need to time the market. You don't need to stare at your phone all day. You need a consistent contribution habit, a diversified portfolio, and the discipline to leave it alone when the market gets scary. Because it will get scary at sometimes. That is normal. That is temporary. And that is when most people make their biggest mistakes by selling. Warren Buffett, arguably the most successful investor of all time, has said that his favorite holding period is forever. You're not looking for a quick flip. He buys businesses he believes in and holds them. And his net worth is over $100 billion. Now, you and I don't need to be Warren Buffett. We just need to understand that time in the market beats timing the market. Every single time. And here's my challenge for you this week. If you don't already have a retirement account, a 401k, an IRA, or a Roth IRA, I want you to spend 30 minutes this week researching how to open one. If you already have one but haven't looked at it in a while, log in. See where your contributions are going. Make sure your money is actually being invested, not just sitting in cash inside the account. These small actions, done consistently, are what separate the people who arrive at retirement with financial security versus the ones who don't. Building wealth is not about finding the next hot stock. It's not about getting rich overnight. It is about making smart, consistent decisions over a long period of time and let compounding doing the heavy lifting for you. This is what this channel is all about. If this video helped you see things differently, I'd love to hear about it. Drop a comment below and tell me, are you currently investing for the long term? Or has this video changed how you're thinking about it? Your comment might just help someone else who's on the fence. And if you're new here and you want a more nonsense content about building real wealth, hit that subscribe button. I put out new videos every week, and I promise we always keep the topics as simple as possible. Thanks for tuning in. Same pace next time. Keep compounding.